Jason, you mentioned own good companies, and certainly we're probably wrapping up earnings season, and hearing from how companies did in the fourth quarter of 2023. Can you talk to us a bit about, what are we seeing with the health of corporate America, if you will, and insights that are coming out of earnings season, and sort of what is that telling us about valuations in the market?
Yeah, great question. So, there are several ways to assess corporate health. There's the balance sheet view, which is assets versus liabilities. There's through the income statement, which is profits and losses. Both lenses suggest, both in this most recent quarter, but also throughout 2023 and even most of 2022, that business conditions remain pretty much on a solid footing, is I guess the simplest way to describe it. Generally speaking, asset values are up, cash balances are high, and as we mentioned with interest rates, those companies are finally earning a return on their cash. So for those companies that have a lot of cash, that's been beneficial. In fact, there have been some analyses done that showed that the net cost of debt, when you look at the rise in interest rates, but also the money being earned on cash, that the net effect of that has been that real costs are lower for companies that are cash rich. And the good news is that we favor companies that have strong cash positions. So that's been good. Liabilities, namely corporate debt, are still benefiting from locked in rates, locked in lower rates from years ago. And I want to be clear, this isn't true of every company. There's certainly dispersion between large and small business, across sectors and industries, even location considerations when we're looking at companies. But in the aggregate, American companies are well run and they're thriving. That said, kind of getting into earnings and specifically what we've seen over the last few weeks with earnings seasons, when looking at the S&P 500 as like a cross section of corporate health, profits in 2023 were at about the same level they were in 2022, so no growth. Now, again, there are, of course, differences sector by sector and company by company, but the sum total of earnings produced over the last 12 months were flat versus the prior 12 months. Now, why is that? We just talked about the economy strong. How can that be? Well, primarily due to profit margins. Revenues were up strongly in 2023 because, again, the economy was growing. So we had, nominal GDP pushing revenues up, but we also had price hikes because of inflation. So revenues looked good last year. But costs were also quite elevated for businesses as well. And in fact, in most cases, costs were higher than revenues. So that resulted in margin compression, which led to stagnant profits. And of course, where we go from here over the near term, we think will be a function of the macro economy. Wall Street analysts currently expect about 12% earnings growth this year in 2024 over 2023. In our view, that level of growth will require an economy that avoids recession and sees margin re-expansion. It's certainly possible, but it's not our base case. We mentioned that recession risks are still elevated. But regardless of the short-term assessment, whether it's like how did companies do in Q4, how did they do last year, what we care about more is the longer run corporate health, and in particular, the corporate health of the companies that we own on your behalf. And the good news is that here we remain quite optimistic over the next 2, 3, 5+ years on the trend in the businesses that we own.
And Jason, those are great points, and it's also important to recognize that not all companies have the same results. Many of the ones that Jason has alluded to that are in our portfolios, they've actually have shown year-over-year earnings growth. An area that's getting quite a bit of press and concern these days is commercial real estate. COVID did change how we use that, and those companies that are investors and managers of commercial real estate are struggling because a lot of people aren't going back to work. There's a glut of office space, and that's got to work its way through the system. There are certainly a lot of financing related to that commercial real estate that ultimately will not be repaid. So we're seeing those impacts both today and coming down the road into the future. And our perspective on those types of areas is, okay, how do we just make sure we're not in front of that train wreck and keep our portfolios positioned in areas outside of that potential for danger?